All right, so right now it's 10 minutes to 9 New York local time. We have swept in 34 level, and we took out the short-term highs at 39.44. So both near-term buy-side liquidity and sell-side has been taken out. After three, again, we're looking at a 5-minute chart on E-mini S&P. So on TradingView, your symbol would be ESM2022 in 5 minutes interval. So if you look at the high that was formed around 5 o'clock in the morning or so, let me see if that's the right time. Yeah, 5:10, 5:15. That high at 39.49 and a half. That was 3 times the market went up. See that? It was a high formed at 3:45 a.m. Then a higher high formed at 4:40 or so, and then 5:15. Then the market broke a short-term low at 5 o'clock in the morning. Fair value gap formed on the 5:40 candle, and then the market traded down. And notice it did not take out the short-term low at 4:10, but then ran up above the short-term high at 6:20 a.m. Then broke down. We created another fair value gap on the 8:10 candle. Displacement on the downside, except for that small little low at 8 o'clock on the dot. And then we broke down and took out the short-term low at 7:10. Now, I'm not saying that you can't scalp that. That's obviously a scalp. But when I'm looking at the market, I'm not looking for these little tiny micro moves, okay? I'm looking for a move that could be framed as a small scalp like that, but I want to be part of a larger price run. I mentioned earlier in the conversation that I'm teaching my students to look for low resistance liquidity runs. That's either going long and running above an old high, or going short, target of running out an old low. That is kind of like my bread and butter approach to trading. There are things that obviously help me frame that logic and that idea, but they are predominantly already taught on my YouTube channel. So you can dig into all those other things that support the idea. But the main thing, if you're a student that just came to me by way of someone saying, hey, look, check this guy out, whatever. Note that low at 410, at the liquidity resting rate below there. There isn't really any imbalance to the left of us. So the liquidity resting below 410 on E-mini S&P 5-minute chart, that's a draw on liquidity. And then there's no real imbalance after that until we get down to the lows at 250. Notice the low at 250 in the morning. Go back a little bit and you'll see that's relative equal lows down there. So there's sell side resting below that. So that's a draw. Let me put that on the chart now. All right, so I forgot what I was saying. Low resistance liquidity run. The idea of looking for trades that are one-sided, where it's easy. You don't have to put a whole lot of thought into it, but waiting for those types of setups. Those are, in my opinion, what traders should be striving to trade and hunt, not looking for just any old pattern. You know, you're all learning my fair value gap. Not every little gap constitutes a low resistance liquidity run entry. Many times it could be just filling it in. It's because it's a common gap. Fair value gaps are part of a underlying logic, and it's not just a small little separation that's highlighted with 3 candles. Okay, that candle at, if you have your 5-minute chart up on E-mini S&P, if you look at the candle exactly at 8:10 this morning on May 20th, 2022, that is the fair value gap. That one candle that is down, the next candle to the right of it has a high of 39.40 and a half. The candle prior to the candle at 8:10 has a low of 39.41 and a half. That gap, because it has already ran buy stops. The buy stops resting above that 620 high. That right there, that is a fair value gap, because it's implying, and the logic behind this and narrative is, the market has already dropped, and we return back into that imbalance at 810, that candle. So it fills in that candle, rebalances, goes back up to the low of the candle at 805. Then price is allowed to release lower and take out the low at 710, because there's liquidity resting below that. And then now we just swept the low, or did we? Did we get that yet? Yep, we swept the low at 410. So when I'm teaching people to look at the marketplace, it's easy for someone to be critical and say, okay, look at this, this fair value gap didn't work there. Oh, this didn't work there. This didn't work there. If you're going to look at what I'm teaching or investigate what it is I'm looking for, don't go in with the mindset saying, let's see how this fails. I want you to go in looking at how I teach you how to find it, because the critics, they avoid all that. They're not going to go through the process of doing it the right way as I outline it. And then you'll see that they exist. They're there in the move every single day, every single week. They repeat all the time. If you go in looking for moves that's just simply because you think it's a fair value gap, that's going to frustrate you, because it's not going to give you moves like yesterday. There may be fair value gaps there, okay, by what is defined as the pattern, but that pattern is not associated with the expected delivery of price for that given day. So what do I mean by that? As I outlined Monday on Thursday, it was a large range day, and we're near the end of the range on that daily run. It was lower from April high to May 12th. So we're, by definition, without the use of an indicator, we're oversold. We don't need an indicator to plot the fact that we're oversold. So the market's really, really, really suppressed, pulled down low. It's at a real deep discount, and we're at the end of the week, and we stopped short on S&P and the NASDAQ before running out May 12th's low. But the Dow was able to go through May 12th's low. So all of those ingredients come together and create this product called consolidation. And those days, if you don't know what you're looking for, when to anticipate them, how to read them, you can go in and trick yourself into thinking there's a pattern there. There's a pattern in anything. You can be fooled by randomness. But when you apply logic and the narrative that would be associated with a low resistance liquidity run, that means it's a high probability one-sided price move that is justifiable only on the side that you're trying to trade. In the beginning, when you're learning, it's not going to feel clear to you as to what that means. And that's why I tell everyone, you have to take your time. You're going to get these moments of astonishment where it's like, I finally got that. It's an epiphany where you discover what you didn't realize was important to you. Now suddenly things become a lot more clear. And that is the byproduct of going through back testing, looking through old data and studying it. Watch that gap at, let's see, what candle was that? 840 on your 5-minute chart. See if there's any response after going into the high on the 845 candles, high at 39.37 and a quarter. See if there's a response in there. We left relative equal lows at 29 and a quarter. And we have sell side resting just below 39.15 and a quarter. So one of the frustrating things I've endured as a mentor and teacher, not just in recent years, but when I was doing one-on-one consultations and teaching one-on-one back in the late 90s, that does not happen. So please don't try to reach out to me. I don't do them anymore, but I'm just referring back to those experiences. I had many times where the people I was working with, they would take what I gave them, follow the instructions, and they were on their way, happy. And I had a handful of folks that were, if I give them a set of rules and say, this is what you're looking for, this is what you're trying to operate and engage with, they would say, okay, I get what you're saying, but. So as soon as you say but, you just cancel out everything before what you just said. What they were saying to me and showcasing is they have no discipline. And many of you learning this, not just under me, many of you are going to discover that you don't have discipline either. I didn't have it either in the beginning. I was literally all over the place, chasing everything because I felt like there was going to be something else that made it easier. When I discovered the easy aspect comes through the grueling process of going through and reading price, studying this candlesticks, it wasn't candlesticks back then, it was a behind the closed bar. But the randomness of price action, what repeating phenomenon were taking place, and studying that. And because I was actually taking trades and losing, I was trying to go back and say, okay, somebody obviously made money on the other side of this trade. So how are they doing it? If I'm losing in my live account and I'm putting money up and I'm buying grain markets, or I'm buying, live cattle or lean hogs, or, crude oil, gold, or whatever I was at the time trading, what was I doing wrong that they could see that was an opportunity? And that was one of the biggest epiphanies for me, is to go back and see what it was I was referring to, and how if I was to reverse it and say, okay, if I didn't look at it with that perspective in mind, okay, if I didn't look at it as, if I'm bullish, I'm buying it. That's all I was doing back in the 90s. I was afraid to short. I didn't understand it. So I was a perma bull. Okay. So if I took a long and I got stopped out, or if I didn't use a stop loss, because I did that a lot in the 90s, I was afraid to put it in the wrong place. So what was the safest way to trade then? In my mind, don't use a stop. And I ruined myself so many times doing that. You have to have a threshold at which this is where I'm wrong. I'm not going to trade anymore. This is where I have to pull the plug. But I would go back in my trades and start reverse engineering it from the other side. Like someone was a bear. And that was one of the biggest discoveries for me, to trust being a short or a bear, is to see when my own live trades were failing, when I was extremely bullish and I had my biggest positions on. I'm long 20 contracts of soybeans. I'm really in there. I'm really trying to do what is likely to be a big move, right? So if it craps out and I'm stopped out and it goes careening the other direction, I'm going in trying to figure out what it is that I did wrong. And if I was a bearish trader, what was I looking for that would be there? And one of the patterns that kept continuously forming is what I literally just gave you all on mentorship on YouTube. That pattern of waiting for a run higher, because I would chase breakouts. I didn't call myself a breakout artist, okay? Because breakout artists, they would literally just leave their stop order above the marketplace and let the market in. Not me. Back then, I was scared. I wanted to see the market really running, really taking off, where a reasonable expectation would be to see the market go maybe 2 cents above an old high. If you're trading the grains, it's like $100 per contract. It's the same as like an E-mini. It's $50 per cent. But I would wait for it to move like 15 to 20 cents. Now, on that big candle up, I'd be chasing it and buying long there. Well, obviously, just static retracements would come back and start scaring me. And I would move my stop loss, if I had one, lower, opening up the risk even larger and larger, because in my mind, I had to be right, because it's been going up. It was really explosive to the upside, but I got wrecked. I got my hinder parts handed to me. And what I discovered was this pattern of going above an old high, then breaking down, and then that secondary rally up. At that time, if I hadn't been stopped out, or if I removed my stop and I weathered that retracement, I would feel like, okay, I dodged a bullet there. And then I would feel more confident, and I'd be in there praying to God, help me get this move past, this level here, keep going up, just let me get out of it even. At that point, I didn't want to be a profitable trader in that trade. I just wanted to be able to survive it and commission, which at that paying $100 per contract. Let me say it again. $100 every contract. Fox Investments. Okay, that's what I was paying as a beginning trader. Everybody was getting raped back then. It was ridiculous. Okay, you guys complain about what you have to pay for your commissions today. This is peanuts. Okay, it's nothing compared to what we were having to pay back in the 90s and before that. It was just, they called it full service brokerage. Full service. Yeah, they're servicing you, right? The hose without no lube. And I didn't know any better. I figured this is what you're supposed to do. And it wasn't until later on I moved to Linda Waldock, where it was a little bit better in terms of the commissions. I think it was around like $30 round turn, which even by today's standards is still, but man, coming from $100 per contract to $30, it's, it's a big savings. But back to the discussion about how this whole model evolved. During that return back to the fair value gap that I had no awareness of, I had no awareness of that fair value gap at all. Didn't even stand out in the chart. I had no idea what it was. Didn't see it. It was always in the charts, but I paid no attention to it because I didn't understand it. But as it went back up into that fair value gap, I'm thinking, okay, my long trade's going to be able to get me back to a point where I can just get out of it because I can't stand it. I'm completely mentally and physically and emotionally fatigued now. I don't have any stamina to be in the market anymore. Not long, not short, nothing. I just want to be out of it. Give me a number one, tweet to me number one right now if you've ever had that experience where you're in a trade and you're just absolutely exhausted. You just want to get back to even. You don't care about being profitable. You don't want to be a net loss on a trade, but I don't even care if it goes to the moon. Just let me get out of where I got in at. That is what these markets will do to you. That is the byproduct of a day like yesterday. You have to know what that feels like. And many of you are so new, absolutely so new, that you don't even know that that's available to you in terms of insight and experience that would protect you. It keeps you from learning how painful that you can blow your account. You don't need to blow your account, folks, to learn these lessons. That's why I'm mentoring you this way. If you go through these learning episodes and take yourself in the market and endure these moments like yesterday, that one day you can look back and say, well, I didn't make any money. This was a waste of my time. This is a joke. This guy can't trade. His fair value gap pattern didn't work. His model's broken. It's fake. It's flawed. It's illogical. He's only hindsight. He's this, he's that. That's what losing traders do. You immediately go to the toxic excuse as to why it's not working for you. When the whole concept and the point was, go into the marketplace, study. What is it doing? How is this going to benefit me? Or more importantly, how could I be harmed by this? Because if these environments repeat, they do. If you know what they look like going in, or once you get involved and you can identify what it is in terms of a market profile day where it's likely to consolidate and chop you up, how do you engage with that? How do you trade it? Well, I gave you insights yesterday on how to do that. Stop trading off until all throughout the afternoon, wait to that last hour trading. And look for a pattern that makes sense. Run my buy stops and pull back to the middle of the range. You don't need it to take out the lows at 39 or 38.55 or what it was. You don't need that. If it pulls back to the middle of the range and you sold short the daily high, who's going to complain about that? I'm sure look around, you'll find somebody. But if you're in here trying to find setups that are consistent,